It is Sunday, March 8th, 2026, 4 p.m. Eastern, and in exactly 5 hours, the Shanghai Futures Exchange opens for Monday trading. 30 minutes later, the SGX in Singapore follows, and 45 minutes after that, Hong Kong goes live. By 10 p.m. Eastern, 3 of the 4 largest physical silver trading hubs on the planet are fully operational, processing orders, discovering price, and moving metal, while 330 million Americans are watching Netflix, brushing their teeth, and going to sleep. Tonight is the night the Asian physical market is going to reprice silver above what the Western paper market believes it is worth. I'm going to walk you through exactly how that process works, mechanically, step by step. Most Western investors have zero understanding of what happens to their metal between 9:20 p.m. and 6 a.m. Eastern Time. They go to bed seeing $85.29. They wake up, and the number is different, with no idea why, no idea who moved it, and no idea what forces were operating on the other side of the planet while they slept. Tonight, I'm going to make you the most informed person in that conversation. Here's the first thing you need to understand. Silver does not have one price. It has 6 prices simultaneously. Those 6 prices diverge most violently during the Asian session, and right now they are telling contradicting stories in a way that is simply unsustainable. Price 1 is the COMEX spot price, $85.29, as of Friday's close. This is the number everyone quotes, the number on your phone app, the number you tell your friends when they ask how silver is doing. But this number is derived from futures contract trading, not physical metal changing hands. It is a paper derivative of a paper derivative. The actual volume of physical silver that trades at this price on any given day is a tiny fraction of the notional value represented. Price 2 is the Shanghai Futures Exchange price. As of Friday's close in Shanghai, silver was trading at the equivalent of $93.40 to $97.29 USD per ounce. That is $8.71 to $12 above the COMEX paper price. In some intraday prints this week, the premium peaked at $14.30 over New York. This price reflects actual physical delivery demand in the largest silver-consuming continent on Earth. Price 3 is the London LBMA fix. This is the price that institutional buyers, central banks, and large industrial consumers reference for bulk purchases. It has been consistently $2 to $4 above COMEX spot for 3 consecutive weeks, reflecting tightness in the 1,000-ounce wholesale bar market. Price 4 is the Mumbai dealer price. Indian bullion dealers are currently selling physical silver at premiums of 12 to 18% above international spot. And that premium has doubled in just 7 days as the rupee collapse accelerated. At a rupee exchange rate of 91.7 to the dollar, Indian households are paying the equivalent of $97 to $103 per ounce for physical silver bars and coins. And they are paying it gladly, because the alternative is watching their savings evaporate in a currency that lost 6% of its value this month. Price 5 is the Seoul retail price. South Korean physical dealers are quoting premiums of $10 to $15 per ounce following the 18% cost buy crash. Korean retail investors carry an extremely well-documented historical behavioral pattern. During the 1997 Asian financial crisis, Korean citizens famously donated personal gold to the government to help stabilize the won. That generation learned a lesson they passed down. When Korean markets crash, Korean families buy metal, not stocks, not bonds, metal. The premiums they are willing to pay right now reflect the urgency of that cultural programming activating in real time. Price 6 is the US retail price. If you go to JM Bullion or SD Bullion right now and add a generic silver round to your cart, you're paying approximately $80 to $92 per ounce after premiums. That is spot plus $4 to $7. For government mint products like Silver Eagles, you're paying $95 to $100, and for the 2026 anniversary Eagle, with the 250th privy mark, the proof version is $173. These retail premiums in America are the lowest of any major market on the planet right now. 6 prices, 1 metal, and the gap between the cheapest price, COMEX paper at $85.29, and the most expensive price, Indian physical at $103, is $17.71 per ounce. That is a 21% spread, and that spread cannot hold. Arbitrage mechanics will close it, and here is the critical point. Arbitrage does not close spreads by bringing the expensive price down. It closes spreads by bringing the cheap price up. Metal flows from where it is cheap to where it is expensive. Buyers in Mumbai are not going to accept lower prices because Americans think $85 is the right number. Americans are going to pay higher prices because Mumbai is draining the supply that was supposed to reach their dealers. Tonight, when Shanghai opens at 9 p.m. Eastern, you are going to watch that arbitrage mechanism activate in real time. Here is how it works, step by step. Step 1. Shanghai opens. Traders in China see that COMEX closed at $85.29 on Friday, and they see that their domestic physical market is demanding $93 to $97. They immediately bid the Shanghai futures contract to $93 or higher, because they know physical buyers will pay that price for delivery. Step 2, arbitrage desks at major banks and trading houses in Singapore and Hong Kong see the Shanghai price spike above COMEX. They execute the spread trade, buy COMEX, sell Shanghai, pocket the difference. To execute this trade, they need to stand for delivery on their COMEX contracts and physically ship the metal to Asia, which means more withdrawal notices hit COMEX vaults Sunday night and Monday morning. Step 3, the COMEX electronic after-hours market, called Globex, is open during the Asian session. As arbitrageurs buy COMEX contracts to execute the spread trade, those buy orders push the Globex price higher. By midnight Eastern, Globex silver is at $87. By 2 a.m., it is $88. By 4 a.m., when London opens, it is $89. Step 4. London opens and sees Globex at $89 and the Shanghai price at $94. London physical dealers adjust their offer prices to match global reality, and the LBMA fix comes in at $89 to $90. Step 5. New York opens at 8:25 a.m. Eastern. American traders arrive at their desks, look at their screens, and see that silver moved $3 to $5 overnight while they were asleep. They did not participate in the price discovery. They did not get a vote. The Asian physical market set the new floor while the Western paper market was closed, and America wakes up to a fait accompli. This process happens every single trading day. But tonight it is going to happen with unprecedented force, because of 5 converging factors that have never been present simultaneously on a Sunday night open. Converging factor 1, the Indian rupee approaching 92. The Reserve Bank of India confirmed intervention in the forex market on Friday, publicly admitting they are burning through dollar reserves to defend the rupee at 91.7. Central bank interventions at round numbers create a specific dynamic. Traders attack the level. If the RBI runs out of ammunition and cannot hold 92, the rupee goes into freefall toward 95 or even 100 to the dollar. That is a 3 to 8% devaluation from current levels. When that happens, and I believe it is a question of when, not if, based on the rate of reserve depletion, Indian silver demand does not increase incrementally. It goes vertical. India consumed 210 million ounces of physical silver in 2025. If the rupee breaks 92, annualized demand projections for 2026 would jump to 260 to 280 million ounces as hedging behavior goes mainstream across the Indian middle class. India alone consumes more silver annually than COMEX holds in registered inventory. Let that number settle in your mind. One country's physical demand exceeds the entire deliverable stock of the primary Western futures exchange, and that demand is about to spike because their currency is crumbling. Converging factor 2, South Korea's Monday morning. Monday, March 10th is the first full trading day in Seoul since the 18% KOSPI crash. The Korean Financial Services Commission held an emergency session over the weekend, and reports indicate they are considering a temporary short-selling ban and a market-wide circuit breaker revision. These are crisis measures. Governments do not revise circuit breakers during normal corrections. They revise them when they are afraid the market is going to crash again on the open, and the existing safety mechanisms will not hold. If Seoul opens Monday and immediately hits a circuit breaker, that is the signal to every Korean retail investor that the equity market is broken. The rotation into precious metals accelerates, and Korean silver demand, which ran at approximately 25 million ounces in 2025, could double within 30 days. Converging factor 3, the Strait of Hormuz insurance rates. Lloyd's of London and the International Union of Marine Insurance updated their war risk assessments on Friday. Insurance premiums for cargo vessels transiting the Strait of Hormuz have increased 412% since February 28th. Carriers that were paying $50,000 for transit are now paying $256,000 or being denied coverage entirely. This does not just affect oil tankers. It affects every cargo ship carrying every commodity through the Persian Gulf, including silver and gold shipments from Middle Eastern refineries and transshipment hubs. Dubai is one of the largest precious metals logistics centers in the world, and the Dubai Multi-Commodities Center handles billions of dollars in gold and silver annually. That hub is now functionally compromised because the cost of shipping metal out of Dubai has become prohibitive for standard commercial transactions. Metal that used to transit from Asian mines through Dubai refineries to Western markets now has to be rerouted around the Cape of Good Hope, adding 12 to 18 days of transit time and $4 to $6 per ounce in additional shipping and insurance costs. That cost gets added to the price, not eventually, but immediately tonight, because the traders pricing Monday's contracts already know that any metal sourced from the Middle East or South Asia is going to cost $4 to $6 more to deliver than it did 10 days ago. Converging factor 4, the nitric acid constraint tightening. As of this weekend, industry contacts report that 2 of the 3 largest nitric acid production facilities in Germany, which supply approximately 30% of European refining capacity, are experiencing feedstock shortages related to natural gas curtailments. European natural gas prices have spiked 58% since the Hormuz closure because a significant portion of Europe's LNG comes through the Persian Gulf. Nitric acid production requires ammonia. Ammonia production requires natural gas. And expensive gas means expensive ammonia, which means expensive nitric acid, which means even more constrained refining capacity. The scrap silver recycling market, which normally contributes 150 to 180 million ounces of supply annually by processing old jewelry, industrial waste, and electronic scrap, is operating at roughly 60% capacity. That is 60 to 72 million ounces of annual supply simply missing from the market. Silver that would normally be refined and returned to the supply chain is sitting in boxes in the back rooms of pawn shops and recycling centers, functionally illiquid because no refinery will process it at current economics. When you hear analysts quote the global silver deficit at 67 to 200 million ounces, most of those models assume normal recycling rates. Adjust for the refining bottleneck, and the actual deficit may be 130 to 270 million ounces. That is a structural shortage that cannot be resolved by opening new mines, which takes 7 to 12 years. It cannot be resolved by increasing recycling because the chemical supply chain is broken. It can only be resolved by price moving high enough to destroy demand. And the industrial users who need silver for solar panels, semiconductors, missiles, and nuclear reactors are not going to voluntarily reduce consumption at $85 or $100 or $150. Converging factor 5, the COMEX vault weekend vulnerability. COMEX vaults do not accept or release metal on weekends, but withdrawal requests submitted electronically before Friday's close are queued for processing Monday morning. Based on the acceleration pattern I have been tracking, Friday's withdrawal requests are estimated at 2 to 2.5 million ounces. Here's the specific vulnerability. When Monday's warehouse report publishes at approximately 4:30 p.m. Eastern, it will reflect not just Monday's activity, but the backlog of Friday after hours requests that were not processed before the weekend. Those combined figures could show a single-day withdrawal of 3 to 4 million ounces, which would bring registered inventory below 78 million ounces. At 78 million ounces, the March delivery obligations alone, currently at 52.63 million ounces with 9.2 million additional potential, represent 79% of remaining stock. No commodities exchange in the modern era has survived a delivery month that demanded 79% of available inventory without implementing emergency measures. Emergency measures include forced position liquidation, cash settlement of delivery contracts, delivery delays of 30 to 90 days, or the nuclear option, force majeure, a formal declaration that the exchange cannot fulfill its obligations. If Monday's warehouse report shows the number I think it is going to show, the countdown to a COMEX emergency intervention drops from weeks to days. Now, let me put all 5 factors together and tell you what I believe is going to happen between 9 p.m. tonight and 9 a.m. tomorrow morning. Shanghai opens at 9:00 p.m. Eastern and immediately prices silver above $90. The premium to COMEX, already at $8 to $12, widens to $12 to $16 as Indian and Korean demand from weekend accumulation hits the exchange. Arbitrage desks activate, buying COMEX Globex contracts and selling Shanghai. Globex silver lifts to $87 by $11 p.m. By midnight, short-term momentum algorithms detect the trend and pile in. Globex hits $88 by $1 a.m. Hong Kong physical dealers open and confirm premiums above $10 over spot. London pre-market pricing adjusts upward, and by 3 hours a.m. Eastern, Globex is testing $89. London physically opens at 3 hours a.m. Eastern. The LBMA morning fix comes in at $89 to $90, confirming the overnight repricing. European physical dealers adjust their ask prices immediately. European industrial buyers who need silver for manufacturing see the higher price and accelerate their purchasing to get ahead of further increases, adding more upward pressure. By the time New York opens at 8:25 a.m. Eastern on Monday, March 10th, silver has been repriced to $88 to $91 by markets that American retail investors had zero access to during the night. The COMEX paper market then has to decide whether to validate the Asian physical price or fight it. If it validates, we trade $88 to $92 all day Monday. If it fights, paper shorts will try to push price back toward $85. But the physical market will resist because no one is selling metal at $85 when they can get $93 to $96 in Shanghai. That fight between paper and physical has been the defining dynamic of silver for the past 18 months, and paper has been winning. The 47.5% crash from 121.78 to 63.90 in February was a paper market victory. The margin hikes were a paper market weapon. The speculative liquidation was a paper market event. But paper market victories require inventory to backstop them. You can sell unlimited paper contracts, but eventually someone stands for delivery and you need to produce bars. With registered inventory at 81.7 million ounces and dropping 2 million per day, that backstop is evaporating. Every paper market attack costs physical ounces to defend, and the vault is running out. Tonight is the night the Asian physical market tests whether paper can still hold the line, with 5 converging pressures hitting simultaneously, with the Indian currency crisis deepening, with the Korean equity crisis escalating, with shipping insurance quadrupled, with refining chemistry broken, and with COMEX vaults hemorrhaging. The most important 4 hours for silver in 2026 begin at 9 p.m. Eastern tonight. You're either watching or you're sleeping through it. The Asian market does not care which one you choose. They are going to reprice your metal regardless. The only question is whether you positioned yourself before they did. This is John AJ Alert. I'm going live on the community tab at 9 p.m. Eastern with real-time Shanghai opening commentary. Do not miss it. See you tonight.